All right, a few other things we need to talk about here in this last part of chapter 9. And so in this slide, we figured out what business gross income is, and we figured out what the allowable deductible expenses are. And so, again, we have to figure out what period we're going to have in order to match up our income and expenses. And so you got a couple of issues. You've got accounting periods, you've got accounting methods, and things like that going on here. So we're just going to hit on some high spots here of this discussion. So let's first talk about accounting periods. Crap. Okay. You get, depending on what type of business you are, you may have some different options on what accounting period you have. So there's 3 possible options. Possible. This doesn't apply to all business entities. You can have a calendar year end, which is 12/31. Any of the business entities can have as its fiscal year or as its tax year a calendar year end. Now, if you are a sole proprietor, not only can you choose, but actually you must choose a calendar year end. Why is that? Well, it's because you're an individual taxpayer, and individual taxpayers all have calendar year ends. If you're some other type of business entity, you can have a calendar year end, but you could also have some other year end. And so the next one we want to discuss is the fiscal year end. And this is for businesses that are not sole proprietorships. And depending on what type of business you are, you may have some choices. And I think we'll get into this more when we get into partnership taxation and the taxation of business entities. Partnerships and those entities treated as partnerships have some special rules about this when you have more than one partner. So let me just put that caveat out there. But for the most part, this is pretty much like what you may have hopefully learned in financial accounting. If you're a corporation, you can have a calendar year end, but if it's more suitable to have some other fiscal year end as your tax year end, you certainly can. A good example would be a retailer. Normally retailers have their tax year end, and usually their financial accounting year end, sometime after December 31st. So it's in that first quarter of the next year. Why is that? It's because sales, Christmas sales, New Year's sales, things like that. And so they may have a February 28th or even a March 31st year end. Now note, all of those year ends, whether it's calendar or some other fiscal year, are all at the end of the month. You can't have a fiscal year that ends on March 15th or something like that. Okay, so it's always got to be at the end of some month. And then they have something called the 52, 53 week year end. They give an example here in the book. You can look at that if you want. I've not seen that hardly at all in my dealings with financial statements and tax stuff. And so the first thing you have to do is figure out what type of business you are. If you're sole proprietorship, you've got to do calendar year end. If you're a flow-through entity, you have to adopt a tax year that's consistent with the owner's tax years. You know, if you've got individual owners, you have to consider their tax years. Again, we'll talk more about that when we get to taxation of business entities. And then C Corps are allowed calendar, fiscal, or the 52, 53 year year-end option. So they've got three options if you're a C Corp. Once you begin a certain tax year, you've got to continue it unless you have a good reason to change to a different tax year, and you have to get IRS's prior approval before you can change. All right, next thing we talk about is, accounting method.